So we'll just run through a couple of slides to give an overview of what's been going on for the last year, and most recently in particular. And then there's a variety of other information at the back if anyone has any questions. Okay.
What's wrong with this one?
Oh, okay. I just thought we had a slightly different startup just to talk about things. So Caravel's recently completed the capital raising. So we now have around 40 million in net cash and market capitalisation of about 105 million with the new shares included in the shares on issue. So just under 480 million shares on issue now. In particular, on the raising, we had support from one of our major institutional shareholders, Paradise, and a range of other institutions introduced by Canaccord. The other significant event in the last few days is the appointment of Don Heimer as Managing Director. So Don comes in to replace Steve, Steve's been running the studies over the last number of years, and Don's background is more in development. So we're moving into the next phase of the project, putting in place a team that can take this project through the final stages of planning for construction and into implementation. Don's experiences in building large copper projects, such as Collahuasi in South America when he was with Falconbridge, and most recently some very relevant experiences, projects director at Fortescue, where he was responsible for the Iron Bridge project. And Iron Bridge has got some very interesting synergies with us. They've installed 10 of the HPGR units, similar to what we're looking at using, 8 of which are identical to what we're looking at using. So Steve can give you a bit of a rundown on that later, but that's one of the key aspects of the recent changes in our project development plan. So we're now well funded to go through that DFS process and move Caravel into a position to be ready for FID late 2040. So just highlighting some of the events over the last year. The mineral resource hasn't changed since about this time last year, but there is further work being undertaken on that. So we remain as the largest undeveloped copper project in Australia, and I think that resource is very likely to grow, as we'll show in a couple of slides later. The scoping study that we completed last year then got developed into the PFS that we released in July, and then most importantly the updated PFS that we released in September, which is what the basis of some of the following information is. The outlook for copper remains very good, whilst it's been a bit weak this year after peaking back in about March, drifting sideways because of all the other things going on in the year. The fundamentals remain extremely strong, with the output from the major producers in decline, and inventories are now at historical lows on the LME, and very high premiums being paid for copper in Shanghai, and the outlook for demand continuing to increase with further and further commitments to major renewable energy projects, which are extremely copper intensive. So we're in a very interesting market where supply is definitely going to fall away from the majors. It's unavoidable, and demand appears to be set for a record increase. So there's going to be a very large gap that has to affect the price substantially. That's expected to happen sometime in the next couple of years, where there's a few new projects that have just come on that are keeping the market in balance right now, but the deficit really opens in about 2024, which is almost perfect timing for when we get to FID and the decision to go ahead. So just a little bit of background before going into the detail. For those that aren't familiar with the project, we're located about 2 hours drive north of Perth in the southwest YILGARN terrain. It's not recognised by many people as a mineral province, and Caravel is certainly the first significant copper project to be discovered, although Boddington, which has been around for a long time, is a very similar age, similar geological setting in many ways, but Boddington's a gold-rich version of Caravel. So although it's debated by some, Boddington is similar to a porphyry, as is Caravel, and Waterton produces about 40,000 tonnes a year of copper. So it's a significant copper producer as well as gold producer. Caravel's got copper rich and has a lesser amount of copper. The other two significant deposits in the southwest terrain are the Greenbushes, largest lithium, hard rock lithium mine in the world, and Julimar, which is one of the largest palladium discoveries in recent times. So it's an interesting story emerging in the southwest. So the Caravel project has a number of very attractive features that make it one of the most interesting projects I've ever been involved with. It's large, which gives it a very long life. Just under 3 million tonnes in resource now, and nearly half of that in reserves. It's a very simple project. It's bulk, open cut bulk mining, which makes it possible to do that at very low cost, and it's very conventional mineral processing. Importantly, that we're on the grid, on the southwest grid, so power inputs into both the mining and the processing help drive down those costs substantially, and that's a key attribute for these types of projects. We're located very convenient to existing infrastructure. There's a heavy haulage road giving us direct linkage through to the port at Bunbury, and we also have a number of towns in the area that provide regional services and labour. Our environmental footprint should be very minimal because we're in open cleared land, farming land, and much of the project layout will be on salt affected country. The ESG metrics of the project are very good because we use a high level of electrification, particularly in the mining fleet, which offsets our diesel consumption. And being close to Perth, we still expect to take full advantage of remote operations opportunities because the fleet will be highly automated. So we expect to have an attractive workplace which allows people to have great flexibility to work from centres in the city, as well as being able to commute to the project without having to go through FIFO. So the Caravel project scale places it as the fourth largest copper discovery globally in the last 10 years. And it's the first one on that list in a country that you consider to be desirable for investment at the moment. So it's one of the very few projects in the world that sits in a location that's rated highly for capital investment. That scale is likely to increase. There's a number of opportunities where we see the resource will continue to grow. And as we announced recently, we've now seen mineralisation. Next slide, Steve. We've now seen mineralisation continuing into the footwall of the Bindi as one example, and that has yet to be drilled out, but we can see a very obvious opportunity for substantial resource increases by bringing that into the project. You can see that material sits immediately under the planned pit margin for the PFS, so it's very likely to come into resource. That's the lower limb. It had two names. It was called Bindi Far East when we only knew about it at the top, and then it turns out that it joins into the resource by the current interpretation, and that's looking more and more robust. And so the lower limb and the Bindi Far East prospect are one and the same. We've only drilled those deeper holes at the moment that show where we call it the lower limb, and the shallow holes on the right-hand side is what we initially called the Bindi Far East prospect. So the interp is they all join up. Yeah, it's a good place to find mineralisation immediately in your footwall. That just requires a cutback in the pit, but probably in year 30 or something, Bernie. So I'm not sure if we're going to be too concerned about it. All about that. Not even my highlight. So the history of the project has been that resource has grown as we've continued to drill, and so we've doubled that resource over the last 6 years, and that's could happen much quicker had we spent more money on drilling. In the future, we expect to see those resources continue to grow in proportion to drilling in the ground. So the PFS, as published as updated in September, showed a very robust project generates strong cash flows, on average around 260 million a year in free cash pre-tax, and that's based around the reserves of about 1.4 million tonnes, but resources substantially larger at 2.8 million tonnes that contain copper. That, as I said before, that positions Caravel as the largest undeveloped copper project in Australia. The key things around the project that we can talk a little bit more about later in the presentation is the way that we intend to develop it. We're using owner mining with automation, electrification technologies that are becoming very much the standard in the mining industry these days, particularly in Western Australia. And they have a range of benefits, not only in cost, but also in ESG metrics. And as I mentioned, the exploration upside within that belt, within that wider belt, is substantial, and so exploration will continue through the life of the project, and I'm sure it will continue to replace resources as they're taken. So the update in September focused on consolidating the plant from a dual train design into a single train design, and as part of that, we also revisited the comminution circuit, and now the comminution plan has gone back to one of the earlier designs, which used HPGR. We were looking at SAG milling in the early stages of PFS because it offered some advantages in capital, but capital costs have changed substantially over the past year, and as it turns out, that favoured the HPGRs again versus the SAG mill. SAG mill costs went up. HPGR, as a more emerging technology, the prices seem to become more stable as they get more units into production. And there's some very substantial benefits from the HPGR in operating costs, and that's become very clear in the test work that we're doing now. So there's a substantial increase in the cash flows from incorporating that HPGR into the circuit. We've also been evaluating some variations on the flotation methodology using a technique called coarse particle flotation, and that offers some advantages in the capital and operating costs for the flotation circuit. And the simplification of the flotation circuit was really just consolidating all of the plant into a single train of larger units as opposed to two trains. The original two-train design was designed to stage the capital cost, and that's not ruled out completely, but the MPV is substantially better on bringing forward production by building that up front, building the whole project, building the entire capacity up front. So the outputs from that are that the capital costs have come down by about 100 million, and that's primarily due to the simplification of the flow sheet. The change from SAG to HPGR didn't affect capital very much. So capital costs are now around 1.1 billion for the plant component of the project, and the substantial change in operating cost from the use of HPGR compared to SAG reduced the operating cost by about $1.30 a tonne, and so that increased cash flows over the life of the project by nearly $1 billion, and that resulted in combination with the capital saving in a $500 million improvement to the MPV. So the MPV now sits at about 1.5 billion. Cash costs have come down to $1.54 a pound, and capital in the plant is 1.1 billion. There's about just under 200 million in working capital for the mining pre-strip, 300 million in the equipment, which is the mining fleet. We break those numbers out because they're going to become different numbers once we get into discussions around vendor financing, which we'll talk a bit about later. So the costs are low, and the key to that is simplicity and scale. So being an open pit with a very low strip ratio is one of the biggest factors in the project's favour in terms of keeping costs low. That allows bulk mining, which means larger equipment, lower unit costs. It also means we're at a scale where we can use autonomous trucks, and that has more efficiency, reduces your labour costs, but importantly increases your availability. And it means those trucks can also at a scale also where they come ready for direct connection to what's called trolley assist. So that picture on the lower right hand side shows a truck with a with a pantograph, which is the same as what you have on a tram, attaching to the quaternary power line on the top, which is same again as a tram. So the truck, when it's coming up the haul ramp, connects to the overhead power. These trucks are all diesel electric trucks, so they have a diesel genset on board driving 4 electric drive motors. And so when they connect to the overhead power, the diesel genset shuts down and the drive motors are powered directly from the grid. So that means the truck not only isn't burning diesel during the haul up the ramp, which is where nearly 2/3 of the energy is consumed, but it's also able to go twice as fast. And that means there's less trucks in the fleet, saves a substantial amount of money. And it's almost a trade, the money saved on the number of trucks is almost equivalent to the cost of putting in the power infrastructure. So that's a very important aspect of keeping the cost down, lowering emissions. And that's possible because we're connected to the grid. The rest of the flotation circuit's very standard crush, grind, float filter to produce a copper concentrate. So there's nothing unusual in the process flow sheet. And the metallurgy is extremely good, floats very rapidly and produces very clean concentrate. All the other things around the project, the access to the port, the proximity to other services, all help bring down costs. And our site is a very simple site for construction. We've got very low earthworks cost to prepare the site, but very little in the way of clearing, very little in the way of moving dirt to produce flat terrain for the plant. And we've got good open areas for the tails and waste dumps. So being low cost means that we can take lower grade. And this is one of the key things to understand about this project. We have a steep grade tonnage curve, and what that means on that diagram on the right is that if we can drop our cut-off grade, we can increase the number of tonnes that become ore. So if you're a high-cost project, you have to have a high cut-off grade to maintain your margins, and that means that some deposits, it means that your ore body may not be mineable. The Caravel ore body at a cut-off grade of 0.2, it hangs together very well, but there's a significant amount of material that sits within that coloured zone in that diagram, which would be between the 0.1 and 0.2. And in a higher cut-off regime, you'd be trying to selectively mine out some of that lower grade material. But that material's still got substantial value. It's still got substantial amount of copper in it. And so most likely you'd be aiming to stockpile that and treat it later, which ties up a lot of working capital. If you can, and it's driven by what your costs and the process part are, you would ideally like to treat all that material up front. And so that's what we've been aiming to do in this feasibility study. And because our process costs are so low, we can take that cut-off grade down to 0.1, and that moves 400 million tonnes of material that would otherwise be waste into being ore. And that means our ore body becomes a continuous wide zone with no selective mining, and that vastly simplifies the whole project. And the material that we treat then, even though it's low grade, is all accretive to cash flow and NPV. So, and that's also the key to the bulk mining, allowing us to use bigger equipment. Bigger equipment means lower unit cost. And so it's a virtuous circle. The more you can drive that, the more you can get your cost down. And that's how all the major porphyries around the world operate at low grades. And that's really the only way that you get these large throughput projects to work. And Caravel has very good attributes for allowing us to do that. And that means we have very low risk on delivering the tonnages to the mill. We can deliver 27 million tonnes. We could deliver more tonnes than that. We're not going to be constrained by the mine. So our unit costs are driven by that whole process. And that brings us down to a low cash cost, particularly low on the mining and also on the plant. Won't dwell on this one, but it's an interesting comparison. If you look at some similar projects overseas, these are operating projects at Gibraltar and Copper Mountain. They're good ones to compare with because being in Canada, it's a similar environment. It's probably more challenging than where we are. They're in the mountains north of Vancouver, but they're operating at similar or lower grades, but very comparable. Higher strip ratios. So when you look at the amount of copper they recover per tonne of ore mined, they're substantially lower. So if you look at our project just on the mining, on the cost per pound for mining copper, we're lower than even significant high-grade projects I haven't done a proper comparison, but I'd say we're almost comparable to things like Sandfire on a cost per kilogram of copper mined. Where the difference is that when you take a lot of that material, you have to then put it through a mill. So you've got to build a bigger mill. And so that the penalty, I guess, for taking a larger scale, lower grade ore is usually in your treatment costs. And that means your treatment costs have to be driven down also by having access to low cost power, and you have to have good metallurgy. And we compare very favourably in all those metrics as well. That's just a schematic showing a lot of these things that we're talking about in terms of the modern autonomous mine, with communications and electrification playing a key role in how the whole project works. I won't talk to that in detail. I will just point out, though, that when we talk about electrified mining fleet, it's not only the trucks going up the ramp using the trolley assist, it's also the drill rigs, which are electric, connected by a cable, and fully autonomous. So one operator can control half a dozen drill rigs or more. And also the shovels, which would be electric, connected by cable. They would be manned, however. And all of the other things, dozers and graders, they're conventional at the current time, and many of them are manned, although as time goes by, more and more of those activities are becoming automated as well. Just a quick explanation of some of those points I made earlier about costs. The breakdown of our costs, when you look at total unit costs on a per tonne basis in the bold, we're around $12 a tonne of ore that we put into the mill, and the key components in that on processing and mining are roughly equal, almost identical, as it turns out. Now, on the mining side, the reason those costs and these benchmark very similarly to similar scale operations, with the main difference for us being under an electrified mining fleet, our fuel consumption is lower and we save on energy costs, and using autonomy, you don't have a massive saving, but you do have on the input costs, but you have a much higher productivity. You don't have people having lunch breaks and shift changes and everything else. So that translates into about a 15% saving over a conventional fleet. That's likely to continue to improve over time, because many of these autonomous fleets are not yet running at their full potential because they're in hybrid environments, and we're using assumptions based on operating fleets. So I think there's potential that we will improve them further. On the processing side, the big variable is power, and power is typically, in many operations, 30% of total operating costs. In ours, it's about 15 or 14, and that's directly a function of being connected to the grid and we're using a power price assumption of about $95 a megawatt hour, which is based on about a $65 a megawatt hour wholesale price, which is where we're at in the West Australian grid presently. Obviously, we've updated these prices in the last year. Obviously, energy is a huge issue all around the world at the moment, and prices have gone up everywhere. WA, fortunately, has remained much more stable than other places, and we hope that will remain in the future. I think being isolated has actually insulated us from some of the craziness that's going on elsewhere in the world. And so we're in a good situation there. If those prices do escalate, we'll probably be better off than anywhere else, even so. The other key things that the benefits on the processing side are the lower reagent, we have a very low reagent consumption, and the other consumables in the grinding media, the ball mills, which have been reduced by the use of HPRG, made a significant improvement. Just to put that in context, there's a couple of numbers here in the top left-hand side to help understand what those numbers really mean. In the early years of the project, we're mining at about 0.29% copper. And when you take into account the recoveries and payability, meaning what percentage of the value of the metal do you get paid for by the smelter, your transport costs and everything else that get deducted, we end up with about $31 a tonne of revenue for every tonne of ore we mine at that grade. So it's very close to being $10 per 0.1% copper if you round those numbers out. So when you look at the cut-off grade I was talking about earlier, that means that 0.1 in our cut-off grade is equivalent to $10 in revenue. And our marginal cost, given that you have to mine that material, whether it's waste or raw, if it sits within your pit shell, that means your marginal cost is the thing that determines whether you're making money or not based on that 0.1 cut-off. And our cost is $5.36 for every tonne that we put through, incremental tonne on the mill. So we still have a healthy margin against that $10 a tonne value for 0.1. And in reality, that means our cut-off could go lower, but then you get into other optimising issues. So it shows how robust this project is and how those cut-off grades can be driven down. Steve, do you want to talk to this one? It's worth making a special point. On my graphics not working. No. HPRG. Oh, it is working. Oh, it's not working on this one. But this is such a key change in the recent flow sheet. It's worth giving a little bit of discussion about.
Yeah, so as part of the change in the flow sheet, we're investigating and doing some test work on our high pressure grinding rolls. So we've sent 2,000 kilos of 2-tonne material to the lab at Bureau Veritas, where they have a weir HPGR. This is actually a fairly large, small scale HPGR unit. It's actually one that's been used in commercial applications, a number of applications. So it is directly scalable. The results to date, and we're still compiling the information, but it's looking pretty encouraging to date. So throughput was quite good. The pressures were relatively low compared to what we expected, and the recycling load, which is the other significant impact, was lower than what we estimated initially as well. So the outcomes of that will come out in the reports from WIR hopefully in the next fortnight, but to date it's looking quite encouraging. So at this point in time, I would say that HPGRs are highly likely to be in the final flow sheet, and as Al's mentioned before, it offers significant advantages compared to the SAG circuit, particularly in terms of operating costs and power consumption, which is great for our project.
So the next stage is completing the DFS over the next 18 months, and it's a fairly straightforward path. There's some additional test work to be done to tighten up our flow sheet and tighten up our cost assumptions around that. But all of the other activities are well advanced, and in many cases, it's just taking them into a high level of detail. Sterilisation drilling around the project area to make sure we're comfortable with the site layout. Doing some detailed planning around our grade control strategies. We are looking at a number of technologies that could substantially change the way that we manage that, such as sensors that sit on the buckets of the mining equipment and determine grade as we go, which could mean that we can remove grade control altogether, and could also mean a significant improvement in the feed grade into the plant. So we want to do all those types of things before we get into the final engineering stages. The additional metallurgical sampling for further test work, like Steve was just talking about on the HPGRs, but also the flotation variability. And we'll be moving down the path on mining equipment selection, potentially as early as late this year, or otherwise early next year. And that'll mean engaging in some key partnerships with whoever those equipment providers are likely to be. We're submitting our environmental approval to the regulator fairly shortly to start that process, which is about an 18-month process. And we're starting to do early work around some of the implementation issues, like strategy for staffing and various other stakeholder consultation. And we're also have started some time ago and continuing our discussions with potential partners for marketing of the offtake and financing. On that issue in particular, given that it's a question that we get asked a lot around how does a company, a junior like Caravel, finance a project that's effectively a mid-tier scale project with over $1 billion of financing required. So we're looking at a range of ways of doing it. And the most important point is that because this project's got the scale that it has, it's of strategic value to players in the copper industry, particularly smelters and traders that are looking for these types of long life projects that produce a clean concentrate in a desirable location to invest. So if this was a smaller project, you could argue it would be easier to finance, but I'd argue that it might be easier to finance as a larger project because it's got that strategic value. And we are getting that interest from those types of partners. So we are very competitive in terms of our costs and in terms of our capital intensity. So it is the type of project that's going to be sought after by any groups that are worried about the impending supply gap. And that's our primary objective, is to bring in a partner that will provide the equity and the debt for us to build this project as Caravel, and they will be a stakeholder in both the equity of the company and the project, one or either or both, and they'll likely be our long-term offtake partner. And those types of deals have been done many times before around the world in copper, but also many times before, particularly in WA, in major developments or in gas and iron ore. So there's lots of precedents and there's lots of relationships that have already been established over many years for doing those types of deals. The other option, keeping all options on the table for now, but the other option is that we partner with a mid-tier company that wants exposure to copper production. Caravel Project's one of the very few around the world that's got the scale to be of interest to those types of companies and has got the location to be desirable. So we have had interest from a number of groups. We have a data room open and we're involved in discussions with those groups. And there are ways in which that could be an attractive outcome, particularly if you look at return on equity. And an example would be the kind of deal that Gold Road did with Goldfields to develop the Gruyere mine. The other thing that we're doing that benefits either of those scenarios is we're looking at options for how we reduce the project capital requirement by vendor financing of as many of the parts of the project as possible. The most obvious is the mining fleet. It's $300 million of upfront capital, but there's $1 billion over the life of the project in the mining service and maintenance contracts and replacement of fleet. So it's a substantial contract, and that's a very sought after contract by the mining equipment vendors. And so we're very confident that we are going to have good terms offered for financing the upfront cost of the mining fleet, with some small component of equity paid down, and in return having that long-term relationship with those mining vendors. The same model applies potentially to other parts of the plant, where because we're very conveniently located to many of the major equipment vendors' warehouses in Perth, it's possible that we don't need to run any of our normal inventory on site. We're only 2 hours to mobilise a piece of equipment from their warehouses. So in having those discussions about how we minimise our inventory costs, that's led to a further discussion about whether we even need to own many of those pieces of equipment. And so we're now engaged in discussions with a number of groups about having much of our replaceable equipment, so not fixed plant, but all of the parts that get replaced regularly, like pumps, motors, and quite a few of the large scale parts within the rest of the plant that are serviceable, having them in place on a service style contract. And that could have a significant impact on our upfront capital costs. Importantly, it would also be a good way of improving our availability and reducing our operating risk. So the timing for all of this to come together in late 2014, completing the feasibility, going into a FID decision to proceed, sometime late 2024, early 2025 into construction and production in 2026, is exactly aligned with when all the current forecasts show a significant drop in a rollover in supply from existing projects. Just using Chile as an example, Codelco, the world's largest copper producer, they are falling off a cliff in terms of their output from current projects. They have to invest over $20 billion to maintain their current level of production. And in Chile also, BHP has to invest $10 billion to maintain their current level of production at Escondida. That's just to maintain production. And it's already apparent that they're not going to meet those targets. The dates are getting pushed out. Codelco's output is down substantially year on year. Chile overall is down 10% year on year in their latest numbers. So since these graphs were made, the outlook for supply has worsened. The outlook for demand It's harder to forecast. It's driven. There's a very fundamental long-term trend of increased copper usage, but Goldman Sachs and others in that chart on the right believe that if the current trend towards electrification continues, then that demand increases at the same time as the supply drops, and there'll be a very large deficit in copper in the copper market. And they believe that's going to drive prices up towards $7 a pound. So even BHP and Rio, much more conservatively, are forecasting prices around $4.50 to $5 a pound. So for us, we're using a $4 a pound price in our feasibility studies. Every 50 cents a pound improvement in that price would increase our NPV on the project by $900 million. So there's a lot of upside in copper price in the time frame that we're looking at for this project coming online. So Caravel's one of the best exposures to the future copper market that is out there at the moment, with the lowest risk in terms of location, and also we have a good price. We have a good basis of C1 cost right in the middle of the cost curve.